Investor Confidence Index out today for April. Thank you very much for your time, Gerda. Let's kick off with the fact that most of the market players now think that the market is too expensive. And that's no surprise because it's been the debate that has been raging really since the beginning of this year.
Yeah, we actually picked up the trend in August last year already. And since then, increasingly, especially the institutional investors felt that the market was too expensive. And now, on a larger scale, the financial managers, the normal advisors advising people on the street is following that trend as well.
I see the extent of the decline on the market is expected to be around about 3.9%. So not a dramatic decline, because in the prior period we were expecting an increase of 0.6%. Again, also a muted reaction.
It's moving sideways, but what is significant is that for the first time on all the aspects that we measure, there's a negative outlook. So the confidence is down on all the aspects that we've measured, and that is for the first time ever.
What has come up specifically in terms of your negative sentiments around the survey that you do and the specific parameters that you measure?
What we measure is returns on 1, 3, 6 and 12 months. That's down for both the institutional as well as the financial planners. And then also on evaluation on the market, more and more people, participants, at 77% of all constitutional participants feel that it's actually expensive, and then also that they also feel that there is no confidence. So if I look at it, I think they're very cautious about earnings in the future.
And the crash, I see that the potential for a crash has, certainly expectations for that has heightened.
It's very low because, you know, on average they feel there's a 20% chance, and that's very low.
It seems to feel like across the board, most feel that we won't see a double-dip recession, but that certainly the growth momentum looks as though it's slowed down significantly. What are the factors that you're looking for in terms of sentiment changing or people feeling more comfortable about the values of
we just ask
assets?
the questions and you know, and get the sentiment from the market. But what I think is what is happening is if you look at what these people are actually doing and what they're responsible for, we ask institutional investors, and they're responsible for investing pension money and also unit trust money. And then the other group is financial planners, but those that are actually quite highly qualified, they call themselves wealth managers. So they're looking after people's wealth. And it was first people lost prior to March 2009. That's quite a lot of money were lost. Then they gained again. And I think they don't want to risk losing money again, so they're cautious. I think what we see is that people are cautious.
Gerda, thank you very much for your time. That was Gerda van der Linde, Executive Director at the Institute of Behavioral Finance. Let's talk currencies as we go into the close of the show and start our weekend. It's going to be quiet, obviously, over the weekend, but Monday when we come back, is all hell going to break loose on the markets in terms of what unfolds at the G20, what's happening in Greece, etc., etc.?
I think the market needs serious clarity in terms of what's happening with the Greece scenario. Obviously, it's creating ramifications across the board. Specifically, I mean, as Gerda was saying, I think a lot of the sentiment is driven by the fact that you know, investors are looking for assets that are quality. They're looking for assets that are low risk. And the problem in the environment that we're currently finding ourselves, specifically driven out of what's happening in Greece, is that it's heightened this risk because there's that uncertainty around what that means. And unfortunately, the contagion thereof is huge and has massive ramifications. And if you look at what we've seen this week in terms of the huge array of data that we've seen out of both the UK, the Eurozone and the US, that has been really positive in terms of growth trajectory, in terms of maintaining momentum that we've seen. It's really been positive. And in terms of earnings that we've seen offshore, we've also seen positive results. And unfortunately, this has overshadowed it, which gives you the perception that it's a massive concern in terms of what type of contagion could result from that.
Obviously, you get asked on a regular basis, what currency should I hold my wealth in, or what currency should I be exposed to? So what are you advising people to do at the moment?
Well, look, at the moment, I would still say if you're a South African investor, you potentially would do better to hold onto your rand right now, purely because the rand trades relatively range bound. It's not, you know, it doesn't take you out of your spread opportunities that you can gain in terms of the yield that you're carrying on a daily basis, because in South Africa we offer quite a attractive yield, as well as the fact that you don't have that uncertainty in terms of the huge volatility that you seeing offshore currently. And I think that's the big swinger. So for now, until we start seeing a better scenario in Greece and we start seeing less contagion within the currencies, and certainly the volatility level starts slowing down within the G3, I still think South Africa at the moment is a better bet.